In this video, we're going to talk about the top 5 causes of big investment losses and how to avoid them. We all know that losing is inevitable in the stock market. I mean, you're going to lose once in a while. That's part of the process. Just like if you're playing basketball, you're not going to make every shot because that's impossible. In investing, it's impossible for every single investment you make to work out. But when you do lose, you want to make sure that loss is small. Otherwise, you can get in big financial trouble and, in the worst case, blow up your entire life savings. Which sounds crazy, but it happens to people all the time. And it's very sad each and every single time. So let's go over the top 5 reasons that people lose big in the stock market so that we don't have to do the same thing. We could avoid it. We want to keep our losses small. So the first big reason why people take big losses in the stock market is because they are too stubborn to exit their position when they're wrong. See, the stock market is kind of nice in a way because it basically tells you when you're wrong. How? Well, the price moves against you. And of course, you start losing money. So it's not exactly hard to know when you're wrong. All you got to do is listen to the market. What is it telling you? But the problem is when you're too stubborn to say, okay, I was wrong, let me sell my position. A lot of people end up refusing to take that loss. And instead of just saying, okay, I'm wrong, let me move on, they start doing all these mental gymnastics trying to convince themselves that, hey, no, I am right. So a few of these things might sound very familiar to you, and it does to me because I used to do the same thing. So say, for example, your favorite stock is heading lower. And instead of getting out, you say, hey, I can just buy more because I'm getting a better price. It's a better value now. Now here's the thing, that type of strategy may work for Warren Buffett, but for most of us, the stock market is just telling us, hey, you are wrong. That's why the price is going down. And if you don't get out of it, you're going to lose more money. But again, we do those mental gymnastics and we say, no, the market is wrong. This is just giving me a much better opportunity. I'm going to stay in it. Another wrong way to think about it that a lot of us fall in is thinking that it's not actually a loss until we sell the stock because it could always go back up, right? It's the idea of paper losses. I haven't actually lost that money until I sell that stock for a loss. And that's a bad way to look at the stock market. Because if you had that mentality, you could quickly see your losses get bigger and bigger and bigger. All the while you're saying, oh, they're just paper losses. But no, eventually you're going to sell and then it's going to turn into a real loss and it's going to be much bigger than it should have been. And these are the same people that get confused by paper profits. They think, why sell my stock when it's going up because I'm making all this money? But the truth is, you don't actually have that money in your pocket until you sell the stock. It can again disappear like that. So the idea of paper profits and paper losses, you really got to wrap your head around it and treat it like it's a real loss or a real gain and then act accordingly. So always make sure that you are not being too stubborn and just take the loss when you need to. Reason number 2 people end up taking much bigger losses than they have to in the stock market is because they have too much ego to be able to take that loss. And this is similar to being stubborn, just like reason number 1. But what happens here is that people start attaching their self-worth to their trades or their investments. And when I say self-worth, I also mean, your ego. So when it comes to admitting that you're wrong, it's really tough to do because you have all your self-image trapped up in that stock. And a lot of people, they come into the stock market because they made a lot of money by being a doctor or an engineer or even good in business. But the problem is that the stock market pretty much equalizes everyone. And even if you're really good at something else, that doesn't mean you're going to be good at the stock market. It's still really, really hard. But if you're a super smart neurosurgeon or something coming into the market, you're like, no way, I got to be right because I was always the smartest ever in everything I did. Why isn't it working here? So even to take a small loss and to admit that they're wrong, it becomes very difficult because that's admitting that, hey, maybe I was wrong and not the smartest ever. And I'm talking about doctors because I'm Indian and my entire family is doctors and they all think like this. And really any high-level professional thinks like this, which is why oftentimes in the stock market, you see guys with no education doing great. The guy who holds the world record for the most gains in a single year in the stock market, his name is Dan Zanger. He dropped out of school and was a pool contractor, so he was installing pools in people's yards, and he's one of the best ever. And a big reason why people with less education do better is because of this. They don't have that ego. They don't have that fragile self all built up that's just ready to be smashed by the stock market. So the guys with the ego, they just dig their heels in and they say, no, I'm going to be right. I'm not going to take the loss. But in the stock market, focusing on being right is actually pretty stupid because what you need to focus on is making money. And the nice thing about the market is if you're wrong, you can quickly flip your position and then make money. There's no scoreboard for how many times you were right versus how many times you were wrong. The only scoreboard is your actual profit and loss at the end of the year. So you can be wrong all the time and it won't even matter. There are legendary traders that have made billions of dollars and they have win rates of 33%. So mostly they're getting things wrong, but they're still the best ever because they switch, get it right, and then make the profit. So don't let your stupid ego cloud your judgment. I know it happens to all of us. You think too much of yourself and then, you can't function right. So don't let your ego take over and prevent prevent you from taking that small loss. Reason number 3 that people take bigger losses than they should is because they have too much hope for a reversal. One of the worst emotions that you can have in the stock market is hope. I know that sounds sad, but it's true, because hoping and wishing isn't an actual strategy. So if your stock is going down, you can't just sit there and pray to God that it goes back up. That's just not gonna work. And again, it's not a real strategy. A real strategy is saying, okay, if a stock hits this level, if it falls that much, I'm gonna get out, because obviously it means that I'm wrong, and at that level I can still take a small loss so I can move on. But as soon as you find yourself hoping and wishing, that means that you don't have your strategy in place. And having your strategy in place when you're in the market is the most important thing you can do. Because what is hope? It's just another emotion, right? And in the stock market, we are constantly fighting against emotions, trying to get them out of the process so we don't make stupid decisions. So the point of a strategy is to actually help you do that. So instead of thinking what to do in the heat of the moment, at which point a lot of emotions start flooding in, hope, fear, greed, instead of doing all that, you already have a game plan of exactly what you're going to do in each situation, and you just follow your checklist or whatever you have. And the most simple example is, hey, if this stock, if I bought it at $12 and it drops to $10, I'm going to sell. Easy. Just do what you said you were going to do. Better yet, put an order in beforehand that just triggers when the stock hits that $10 mark. Then you don't even have to worry about it. It's automated. That's really a lot of what stock market investing is, preventing yourself from screwing yourself over. So always, always, always remove those emotions as much as you can, because the stock market does not care about you, your hopes, your dreams, your emotions, nothing. So don't sit there and hope for a reversal, because you are going to take a much bigger loss than you should have. Now, the fourth reason that investors take big losses is because they're trading too big of a position size. And this point right here is something that is so important when you're investing, but most people don't think about it at all. And it's also something that professionals spend so much time on trying to optimize and fix, because it really is that important. And what we're talking about here is how much are you putting into each investment? How big is your bet? Now, normally when people first get into the stock market, they are oftentimes betting way too much money on each individual stock. And there's a few problems when you do that. The first problem is that you have way too much risk in one stock. So if something happens, say the CEO of the company that you're invested in falls down a stairwell. Well, if the stock price drops 30% immediately overnight, you have way too much money invested and you're going to take a huge loss. That's why all the smartest investors talk about diversification. You do want to spread your money out across a few investments so that you don't have all your risk concentrated in one thing, because bad things happen in the stock market all the time for no rhyme or reason, and you don't want to be a victim of that, because when it does happen, that's when you can take a big loss. Now, the second problem that you'll run into if you're sizing too big and putting too much money into one investment, and this is more of a knock-on effect, is your emotions are going to be all out of whack. As soon as you have too much money on the line, your emotions are much more likely to take over. And the things we were talking about before, reasons 1 through 3 why people lose too much money. They're too stubborn to exit when they're wrong. They have too much ego. They have too much hope for a reversal. All of that becomes so much worse when your position size is big, because all of a sudden you feel like you got way more on the line. So instead of selling and taking a small loss, which percentage-wise, even though it is a small loss on that position, if your position is too big, it might feel like a huge loss from just the dollar amount. A 1% loss on $1,000 is very different from a 1% loss on $100,000. And yeah, we try our best to just keep everything in percentages and numbers, but really, when you look at the actual dollars, the notional amount, it affects you. Your emotions are going to be out of whack. So one easy way to make your life much easier and safer so you don't lose a bunch of money is just reduce how much you're investing. And in general, when you are entering the stock market, you never want to be betting or investing what you can't lose. Because guess what? No matter how great your strategy is, no matter how great you are at the markets, there's always an inherent risk to investing. Things can drop like crazy overnight, again, for no reason, and you can get hit bad. Things can go south, companies can go bankrupt, and you never want to be in a position where you can't take that loss. So never bet what you can't lose. What did Warren Buffett say? Don't bet the farm unless you have another farm. When people get excited and start slinging around too much money, it just leads to problems. So remember, to avoid big losses, try trading smaller. Reason number 5 that people take bigger losses than they should is because they start buying stocks in a downtrend. Here's the thing about the stock market. Each stock, even though they're different, they're still all highly correlated. Most stocks just move together. So here's a good rule of thumb, which actually I think came from Steve Cohen, who is the basis of the character they created in Billions, Bobby Axelrod. So he's pretty much a crook, but he's still a super smart guy because he did in fact get away with it, and he does know about markets pretty well. But anyway, he said that 50% of a stock's movement comes from the overall market, 30% comes from its specific industry, and 20% comes from the stock itself. So what does that mean? Well, how your stock price is going to move, 50% of that is just going going to come from the overall market. So if the S&P is down today, there's a high likelihood that whatever stock you're holding is down as well. Same thing if the industry that your stock is in is down. Likely your stock will be down too. Only 20% is based off the actual stock itself. You got to understand what the overall market is doing to be able to be successful with individual stocks. And people start taking huge losses when they don't understand that, because the market could be in a downtrend. And if you're still trying to buy stocks and hit an uptrend in them, well, you're just like fighting waves, right? Everything's moving this way and you're trying to swim upstream. It's not going to work. So you can't get just so hyper focused on your individual stock that you ignore the larger market. I'll give you an example. I was talking with a friend the other day about Tesla. Now, everyone thinks I hate Tesla, but in fact, I'm a huge Tesla and Elon Musk fan. So when we were talking about the potential for Tesla in the future and what Elon can do with SpaceX and Neuralink and all of this, I'm like, yeah, this company can go to the moon for sure. The valuation, I can't even tell you the potential because I can't even imagine it. The guy is doing crazy things. He's amazing. But does that mean that you put all your money into Tesla and just let it ride? No, it doesn't. Because even though Tesla seems so amazing, it can absolutely get hammered if the general market turns around. And when I say hammered, I mean like fall 80-90% even. The same thing happened to Amazon in the 2000 bubble. When it popped, Amazon got knocked down like 90%. Is it because Amazon was a bad company? No, of course not. It was an amazing company and it came back, but try holding on when your life savings gets knocked out 90%. It's not a good strategy because what if you had to retire in 2008? You had to wait forever for it to recover. And again, it wasn't Amazon's fault. It was just the general market. So the general market can really tank your stocks if you're not paying attention to it. And you're not going to want to take that loss. And you don't want to take that bigger loss than you have to because you weren't watching. So you really got to remember how important the overall market is when you're investing in these stocks. And you should not be buying stocks when the overall market is in a downtrend. Now, there's one more extremely important thing you need to do if you want to avoid taking big losses when you're investing. We actually made an entire video about it right here. And you're definitely going to want to watch this video because it fits really well with everything we've just been talking about. In fact, it ties it all together and shows you how to apply it. So click this link right here and I will see you in that video.